Hello, ladies and gentlemen. Thank you for standing by and taking the time to join us for today's webinar, Testing for Qualified Mortgage Status. My name is Seda Kempf, and I'm a Marketing Manager with CliftonLarsonAllen. Before we get started, I'd like to cover a couple housekeeping items. If you experience technical difficulties, please dial 800-422-3623. All participants are in a listen-only mode. If you have questions on today's content, we have planned for a Q&A session at the end of the presentation. Your questions can be submitted via the questions function. If you haven't already downloaded the presentation slides, another copy of the slides, as well as the webinar recording, will be emailed to you within the next 10 business days. And finally, we invite you to fill out the survey that will pop up after we end today's session. Your feedback helps us to build strong programs in the future. For those of you who may not be familiar with us, Bankers Advisory, a CliftonLarsonAllen division, is a consulting firm focused on helping mortgage institutions across the United States with regulatory compliance and quality control. The firm provides premium file evaluation services for mortgage, credit risk, and compliance assessments in the area of fair lending, state, and federal regulations. CliftonLarsonAllen is a professional services firm with 3 distinct business lines, including accounting and consulting, outsourcing, and wealth advisory. The firm serves more than 1,100 financial institutions in the country, and we have a staff of 3,600 members from offices coast to coast, including 200 professionals and 25 principals who focus exclusively on financial institutions. Without further delay, I would like to introduce today's presenter. Marissa Blundell is a Client Services Director. She serves as a Contracts Administrator and Customer Relationship Manager and develops and implements compliance training to clients and on behalf of trade associations. Marissa serves on the Compliance Committee and co-chairs the Legislative Committee for the Massachusetts Mortgage Bankers Association. She is a graduate of Skidmore College and earned her Juris Doctor at the New England School of Law. Before I turn it over to Marissa, I'd like to go over today's learning objectives. At the end of the webinar, you'll be able to understand the qualified mortgage criteria related to the consumer's monthly payment for the transaction and total debt-to-income ratio, examine the underwriting guidelines contained in Appendix Q, understand the test for determining whether a qualified mortgage loan is a higher price transaction, and consider the qualified mortgage status provided to certain transactions under several special rules applicable to certain creditors and transactions. So let's move forward with the presentation. Marissa, I'll pass the mic over to you to get us started.
Thank you, Seda. Hello, everyone, and thank you for joining us this morning. We've had about 60 days go by since the effective date of many of the new mortgage rules, but many of you may be just about to close your first QMs, or you may have just closed your first QMs in the very recent past. So we thought this would be a good time to think about some strategies for testing your loans to see whether or not the plans and procedures that you've implemented in order to comply with the ATR rules may be working great or may need some adjustments. So what I hope to be able to do today for you is to highlight a few of the considerations that you'll want to focus on if you find yourself having to demonstrate that a particular loan is, in fact, a QM. So we're going to start with some context. Of course, the Dodd-Frank Act, among its many rules and regulations that it required, provided that the Truth in Lending Act was going to be amended to require that creditors determine, based on a good faith determination, that a consumer had a reasonable ability to repay a loan before extending that credit. Now, violating the ability to repay rule carries some substantial penalties. So making a qualified mortgage is one way that a creditor can receive some legal protections from claims by, for example, a consumer alleging that they were giving a loan before a creditor or without the creditor forming a good faith and reasonable determination that they had the ability to repay that transaction. For many institutions, compliance with the general ATR rule is going to be achieved by originating a QM loan. Now, keep your perspective here. The actual regulatory requirement is not to make QMs. So, for example, your examiner is not going to be looking to see whether or not you made a qualified mortgage. What they'll be looking for is to see that you are complying with the ability to repay rule, saying that you must make a good faith and reasonable determination that the borrower has a reasonable ability to repay the loan according to its terms. Now, they may very well, if you indicate to them that you hope to be originating QMs, most examiners that I've spoken with have indicated that they would be happy to look at them and try to assist you to ensure that you are, in fact, originating what you believe to be QM loans. However, there is no actual requirement to make a QM. Now, there may be investor requirements, or your own institution may have decided that as part of its overall risk management strategy, it wants to originate QM loans. So there will be, I'm sure, many instances in which you have to demonstrate that a transaction satisfies the QM criteria. And that's what we're going to talk about today. But I just wanted to make sure that you have the overall context of how the QM relates to the ability to repay. Also, one other kind of background piece of information. There are two different levels of legal protection that originating a QM loan is going to provide. And that is going to turn based on whether or not you have a QM that is higher priced. The higher priced QMs are QMs with APRs that are exceeding the APOR index for comparable transactions as of the date the interest rate is set. That's important. By greater than 1.5 percentage points for first lien loans. Other than that, QMs are still QMs, so they have to satisfy the same 6 criteria, which we will talk about in a couple of slides. However, the APR is really what is going to set apart a higher-priced QM from a regular QM under the general QM standard. Now, the general QM standard for a loan that is not higher priced is going to provide a safe harbor for compliance, whereas compliance with a QM that is higher priced is going to be a rebuttable presumption of compliance. And what that means is that in order to stop litigation in its earliest stage, you want to have a QM that is not higher priced and gives you a safe harbor. That would be your, if there are internal counsels on the call, that would be your motion for summary judgment in the event somebody challenged your institution on an ability to repay claim and you have a loan that is a QM. So as a matter of law, when you establish that your loan has satisfied each of the QM criteria and is not higher priced, that would be enough to halt the litigation at its earliest stage. A rebuttable presumption provides an opportunity for a litigant to challenge the underlying presumption that a loan is that a borrower has the ability to repay that loan. When you have a QM that is higher priced, there is a chance that a consumer will be able to successfully rebut this presumption of compliance. And realistically speaking, it's generally understood that if a consumer is successful here at this stage, you will probably have a significantly uphill battle to demonstrate that, in fact, the loan was made based on a good faith determination that the borrower had a reasonable ability to repay, because in order to rebut the presumption, the consumer essentially has to prove that in the first instance. So that's just a little background information about the two different types of QMs and the different levels of legal protection that each affords. So getting right into the general QM criteria, we have a few. The first, this is supposed to say 1 through 6. I'm not sure what happened there, but just to let you know, the first couple of criteria are going to relate to the loan transactions features. So this is periodic payments, the loan's term. Then we will have the pretty complex requirement regarding limited points and fees. So the criteria that's going to relate to the transaction's costs. And then we have the final 3 criteria, which I like to think about in terms of QM underwriting criteria. So these 3 items are going to relate to underwriting using the correct monthly payments, and then verifying the consumer's reasonably expected income and assets, and finally calculating the debt-to-income ratio and making sure that that complies with a cap of 43%. So getting right into our requirements, the first regarding the substantially equal periodic payments, one thing I wanted to mention here is that the rule does account for differences in a monthly payment that are the direct result of an adjustable rate loan resetting. So that is not going to disqualify, having an adjustable rate loan is not going to disqualify the transaction from being a QM because of the substantially equal periodic payments. As long as that loan doesn't have any additional features that are set out, such as allowing the consumer to defer payments of principal, or to permit negative amortization, or to result in a balloon payment. So as long as the adjustable rate mortgage doesn't do any of those things, an exception is made for the fact that the payment will in fact change as the interest rate adjusts. So it won't wind up being disqualified under the requirement that a QM have substantially equal periodic payments. The loan term may not exceed 30 years, and this is calculated from the date of the first payment, not consummation. And we arrive at our requirement related to points and fees. Now, I'm not sure exactly what the makeup of our audience is. It tends to be, for the compliance folks, points and fees seem to be a little easier to digest, and for the underwriting folks, the requirements with respect to Appendix Q are certainly more of a comfort zone. This rule does it both, so we need to have kind of a situation where we have both of those departments working together in terms of possibly needing to demonstrate that these criteria have been met. But with respect to the points and fees, we have certain limits that are going to be determined based on what the loan amount is. So we have a couple of thresholds that are calculated as a percentage of the total loan amount, and we have a few thresholds that are actually flat fees, and as you get to smaller loan amounts, you will see that percentage-based threshold increases accordingly. So the first step in determining whether or not a transaction has satisfied this criteria related to limited points and fees is to figure out exactly what your points and fees for the transaction are. And the way the rule is designed, it sets out 6 general categories of fees that, if they are known at or before consummation, must be counted towards that total amount of points and fees that you will then compare to the applicable cap. And those categories in general are listed here on this slide, and we're going to talk about each of them in turn. So first, we'll talk about the first general category of points and fees, and these are your mainly your finance charges with several exceptions. So there are several finance charges that are not going to necessarily be counted towards the total amount of points and fees. But you'll start by looking at your fees for the transaction, putting all your finance charges together, and then you will start to basically deduct based on certain exceptions to arrive at the actual finance charges that are going to count towards that total. So, for example, we know that interest is not going to be counted towards the points and fees total. The federal or state government-sponsored MI premium, the upfront premium, is not going to be counted. Private mortgage insurance premiums that are paid after consummation are not counted, and the upfront premium paid at closing will be excluded up to the amount of the FHA upfront MIP that is applicable at origination. And finally, well, not finally, but one of the other exceptions, finally on this slide, is that bona fide third-party charges not retained by the institution, originator, or an affiliate will be excluded unless the fee is included under a different category. I'll back up 1 second so you see. Remember, we have 6 general categories. So what this exclusion for bona fide third-party charges at the bottom of this slide is referring to is saying if a fee is included under another broad category, for example, such as loan originator compensation, it's going to need to be counted even though it's a bona fide third-party charge not retained by the institution. And one other note here, this bona fide third-party charges may exclude some fees that are finance charges. Thinking particularly in terms of like the tax service fee or the flood fee, the flood certification fee. These fees are finance charges because they're required by the creditor, but that's not a portion of this exclusion here. The bona fide third-party charges not retained by the institution, loan originator, or affiliate are just that. So it may exclude some additional finance charges from your total of points and fees, unless that fee is included under another category of points and fees. Another note here just to keep in mind, this is where if you've been listening to the discussion as the rule progressed about loan level price adjustments needing to be counted towards the points and fees. This is where that discussion originated. The loan level price adjustments that are passed on to the borrower as a fee are specifically going to be included in the total of points and fees for the transaction. However, if the method of sort of recouping that loan level price adjustment is simply to increase the borrower's rate, then you don't have a fee to include. But I would say you want to be mindful of the fact that as you increase the rate, there will be other rules that may be coming into play, such as HOEPA's coverage, which is going to be based on that relationship of the APR to the APOR index. So just an aside on loan level price adjustments, but this is where that was coming from. If you have bona fide discount points, they may be excluded under the following provisions. So depending on, again, your rate, so this is another place where if you're going to build things into the rate, you've got to be mindful that you may be blocking yourself out of yet another exclusion related to points and fees, because you have a number of points, up to 2, that can be excluded as long as they're bona fide and reduce the interest rate according to established industry standards. So long as your interest rate, your APR for the transaction doesn't exceed the APOR by more than 2 percentage points. If you have a APOR comparison that is 1 percentage point or less, you can exclude up to 2. But if you are exceeding the APOR index by more than 1% but less than 2%, you can only exclude 1 of the bona fide discount points. Okay. The following general, so that closes out our general category of finance charges and what is included and what is excluded from that total amount of points and fees that you'll compare to your threshold. The next general category is loan originator compensation, which does need to be included. However, there's a big exception here for compensation that's paid by either a creditor or a mortgage broker, a mortgage loan originator organization to an employee. If that piece, if the loan originator compensation is the employee piece, that does not need to be counted towards points and fees. However, if you're in a wholesale transaction and you have creditor paid loan originator compensation going to the mortgage loan originator organization, that amount does need to be included towards the total of points and fees. Even if you happen to have additional origination charges that are being charged in that transaction, you would still need to count that compensation towards the total of points and fees. You will also be able to exclude, there are some specific provisions with respect to manufactured home retailers employees as well. Okay. We're still on points and fees, but we're gaining on it. The next general category of points and fees is dedicated to the real estate-related fees. Now, these are the fees that are generally excluded from the finance charge. However, what this rule says is if they are either unreasonable or if the fee results in direct or indirect compensation in connection with the charge, to the institution, or if the fee is paid to an affiliate of the creditor, then you are going to need to count that real estate-related fee towards the total that you're going to compare to your threshold. Now, affiliated entities, that's going to turn on control. There's a whole other discussion to be had there. But what's important to take away from here is you've got to be very careful. If you have any affiliates that are performing services in the area of your residential mortgage loans, you're going to want to make sure that you know exactly what those fees are, because they will need to be counted as part of that total of points and fees, even though they are excluded from the finance charge. This slide just has some examples of the real estate-related fees. And our next general category of points and fees relate to insurance premiums. Now, the popularity of these different types of insurance premiums, I think, has waned over the past couple of years, but you have to keep in mind if there are any other premiums being paid for items such as credit disability or employment or credit property insurance for which the creditor is a beneficiary, you are going to need to include those premiums that are payable at or before consummation in your total of points and fees. And our last two general points and fees categories relate to prepayment penalties. Now, if you have a prepayment penalty, which I will throw out here, keep in mind that the general rule regarding the ability to repay also contains several restrictions about when it is permissible to have a prepayment penalty. A little ironically, one of the few times you can have a prepayment penalty is if you otherwise originate a QM loan. So that's why this is here, because if you have a prepayment penalty, they are going to also require you to count that towards the transaction's total points and fees, rather than the maximum prepayment penalty that might be charged under the terms of the mortgage loan. Finally, if there are prepayment penalties that are being incurred by a consumer who's refinancing with you and you are the current holder of that loan, or an affiliate of yours is the current holder of that loan, then you would need to include that prepayment penalty being paid by the refinancing consumer as a point and fee as well. So to wrap up our points and fees discussion, keep in mind that in many instances, charges will be paid by parties other than the consumer. So the rule does set out a few exceptions here. Specifically, we know that seller's points, keep in mind those are already excluded from the finance charge. Those are not going to be counted towards points and fees. But if a seller pays, or another third party pays a fee on behalf of the borrower, that has to be included under the points and fees categories, such as, those related to compensation or real estate related fees or premiums. That fee has to be counted towards the total points and fees, even though it's being paid by a third party. So this third party exception doesn't get you around the otherwise specified categories of points and fees. I will note here, though, that if a creditor pays the fee, I think that the way the rule is approaching it is more like a waived fee than a third-party paid fee. But if a creditor pays certain fees, as long as it's not the loan originator compensation in a wholesale transaction, which has definitely got to be included, then you wouldn't need to include the charge towards the points and fees. Again, this is kind of whether or not there would be any fees. At this point, most people are, if you are waiving a fee, it's sort of in a credit to the borrower that gets applied. But that is another wrinkle here in the area of charges paid by parties other than a consumer. So once you have your totals, points and fees, you're going to need to compare it to the proper thresholds. And I just want to point out some potential areas of confusion here. For example, we have these phrases, loan amount, total loan amount, and they mean different things. So if you have a loan that's greater than or equal to $100,000 and you're going to be in that 3% threshold cap, it's 3% of the total loan amount. Now, the total loan amount is not the face amount of the note. It is actually defined elsewhere in the rule, and it is defined to be the amount financed, possibly adjusted by some certain creditor-financed points and fees. It's the same calculation that you would use for HOEPA coverage, and I just wanted to make sure that that was clear. So when you are calculating what your cap is going to be, that 3% of the total loan amount, you need to be using, in most cases, the amount financed. If you happen to have a situation where a creditor is financing certain expenses that would be counted under points and fees because they are real estate-related fees paid to an affiliate, or the premiums for credit life or disability and unemployment premiums, insurance premiums, or total prepayment penalties, then you would actually need to reduce the amount financed further before calculating the cap. But again, that's a limited circumstance when there is creditor financing of certain points and fees from those other categories, and it's not necessarily going to be something that comes up in every transaction. But what you will need to do if you are calculating a percentage-based threshold is make sure that you're using the total loan amount, which is many times going to be equal to the amount financed rather than the face amount of the note. Now we're going to move on to our discussion of what I kind of refer to as the QM underwriting criteria. And the first is that the actual monthly payment that's going to be used for principal and interest as part of the loan approval process has to be calculated using the maximum interest rate that may apply during the first 5 years after the date on which the first periodic payment will be due. Now, with this is actually similar to when you talk about the first periodic payment. When there was in 2011, when TILA changed again, and we had to use the new disclosure form, and they wanted you to put the amount that the payment could rise to within the first 5 years, and there was a lot of discussion about whether or not there was any change within 5 years on a 5-year loan. Again, we are going to calculate our 5 years from the date the first regular periodic payment will be due. Therefore, that is going to be that 60th payment. So if you have a 5-1 ARM, you will have an adjustment on the 60th payment, and what you will need to use for the purposes of underwriting and getting to your total debt-to-income ratio is the principal and interest that's calculated using that maximum interest rate. The other thing you'll need to keep in mind with adjustable rate loans is that you will need to assume that the rate increases as rapidly as possible under the terms of the note. But you can give effect to certain, for example, 2% payment adjustment increase caps. So we have an example on a following slide that we'll talk a little bit more about, but I just wanted to point out, so there are a couple steps related to making sure that the monthly payment for principal and interest is properly determined for the purposes of underwriting. You will also need to make sure that you're using a payment stream that is going to fully repay either the loan amount over the loan term or the outstanding balance over the remaining term. And the underwriting monthly housing payment is supposed to also account for any of the mortgage-related obligations. This is a little more information about the maximum interest rate in different amortization situations. And there's an example at the bottom where you will see there is a 2% annual interest rate adjustment cap. So even though you've got a fully indexed rate of 8%, so even though you have a initial interest rate of 5%, and after the 60 months, the rate will adjust annually, and there will be a specified index plus a margin of 6%. So this could possibly go from 5% to 8% really easily. But then there is a 2% annual interest rate adjustment cap. Then you would underwrite using the monthly payment of principal and interest that's based on 7%. The last two criteria for the QM relate again to, think back to your regular ability to repay criteria. With respect to number 5, here it is again. You have to make sure that your loan is being underwritten using verified income, assets, and debts, and those income, assets, and debts need to be verified using the Appendix Q guidelines. We'll talk about Appendix Q in a few slides. So the final QM requirement basically will be determined by your correct application of the previous QM requirement regarding the determination of the consumer's income or assets that you have verified and documented and have found to be stable, and then using the previous slide's calculation of the principal and interest payment for the using the maximum interest rate. When you calculate your total monthly debt to total monthly income ratio, it is going to need to be less than or equal to 43%. This is where folks talk about 43%. It has to do with this final QM criteria, and it is based on the standards located in Appendix Q. Appendix Q will give you some additional details about which obligations you also have to include besides the monthly housing expense payments. But in general, you will take your resulting monthly payment for principal and interest and the mortgage-related obligations. You will add it to the debts as verified in accordance with Appendix Q, and you will compare that total debt ratio to the total monthly income that is likewise verified in accordance with Appendix Q under QM requirement number 5. We'll talk a little bit now about Appendix Q in order to properly apply those final 2 QM criteria. We know from the commentary that was issued with this rule that the CFPB expects that there may be scenarios with respect to whether or not a particular inflow of money is going to be considered income that can be used for qualifying purposes, or whether or not a particular monthly expense is a debt obligation that will need to be included in your total debt-to-income ratio. They expect that Appendix Q might not necessarily resolve every one of these specific scenarios. So what they have said is you can rely on additional information that's either published in, for example, HUD's underwriting guidelines or Fannie and Freddie guidelines, and you can use that additional information to resolve issues that are not specifically addressed in Appendix Q. However, and this is a big however, what you cannot do is use guidance from another source to reach a result that is contrary to, even though it might be more general than specific, general guidance that is set out in Appendix Q. So you can use other sources to resolve issues in a consistent manner. What you can't do is use other sources to get around. If in general it says to exclude a particular type of, include a particular type of debt in your total monthly debt obligations, you can't use another source to exclude that debt, even though it may be a debt that is similar to but not precisely the type of debt mentioned in the rule. So that's just kind of some background on the use of Appendix Q. But in general, income that is going to be used to reach your QM debt-to-income ratio, or rather to keep you under that debt-to-income ratio cap of 43%, has to be stable, verifiable, and continuing. The Appendix Q guidelines require a verification of the consumer's employment history for the past 2 years, and there's a little discussion here. This is a change. Appendix Q underwent a revision before the final rule was settled. So the final rule that came out in January contained some information in Appendix Q that was changed. So don't forget, we had 4 final rules in this area, and you have to keep making sure that you are referring to the most recent iteration of Appendix Q. And so that was in the July 2013 final rule. And it said, basically, that you can assume, in the absence of information to the contrary, that employment is ongoing. So you have to do your verification of employment, and you cannot ignore, for example, if an employer says that the consumer is about to be or has been terminated, you can't ignore that information. But as long as the current employment is verified and it's current, you can consider that to be ongoing in the absence of information to the contrary. There are specific types of income that are going to be subject to additional documentation requirements and other specific considerations, such as developing average amounts over the previous 2 years. Overtime and bonus income is one where you have to average the overtime and bonus income that was received for the past 2 years and establish a trend. And you can only use bonus and overtime income if that amount is not declining continuously. And you will be able to add that additional income to your consumer's regular income from employment, so long as you follow those additional steps. There are several specific requirements that apply to self-employed borrowers. Just know, for the purposes of Appendix Q, you're going to trigger the self-employment requirements when you have a consumer with an ownership interest of greater than or equal to 25%. That's going to be the threshold for determining whether a consumer is self-employed or whether a consumer happens to be employed by, for example, a family business. And there's actually specific rules related to that as well. The self-employment history of the consumer will need to be verified, and there's a restriction. You cannot count the income as effective unless the borrower has a 2-year history of self-employment, or you fall into one of the two sub-rules on this slide. If you look at Appendix Q, this is actually in one of the charts, and you will have a situation where if you have a self-employed consumer who has been self-employed for less than 2 years but at least 1 year, then a combination of 1 year of self-employment and 1 year of formal education or training in the same line of work will be enough to consider that income stable and effective. If you have a self-employed person who has been self-employed for less than 1 year, Appendix Q says that is not going to be effective income. There are special documentation requirements for self-employed consumers, specifically the federal business income tax returns and year-to-date profit and loss statements, so that you can properly analyze the earnings trend for self-employed consumers, and also so that you can analyze the financial strength of the self-employed consumer's business. This was another area where there was a little change from the January rule to the July rule, because they had sort of at first, they put out this standard of determining the financial strength of a self-employed consumer's business, and it was awfully fuzzy, and I think it made a lot of people very nervous. And so one of the things that they did differently in the July rule is they said, look, annual earnings, after you do your analysis and calculate your earnings trend, annual earnings that are stable and increasing are going to be acceptable, while businesses that show a significant decline over the analysis period are not acceptable. But you won't have to get into what the market is doing for a particular type of employment. The next general category of income that Appendix Q addresses is the non-employment related income. So, for example, if you have income from alimony, child support, or separate maintenance, and I put a note here, remember, this is income, so ECOA applies if they they have to have all their proper disclosures, and then if they choose to disclose that they would like to use income from these sources, this is the method through which you would verify and determine that that income is stable. And this would require documentation that the income is in fact being received consistently, that it has been for the past 12 months, and that has to be documented and verified. So this is going to include acceptable evidence like canceled checks and bank statements. You will have to show that the income is likely going to be received for the first 3 years of a mortgage. And so this is going to be documented either by a final divorce decree or a separation agreement or court order. A little note down there about child support payments being grossed up under the same provisions as non-taxable income. We'll talk about that briefly in a couple of slides. Eligible investment properties is another potential source of non-employment-related consumer income for which there are special rules. I'll spend a few minutes on rental income because this tends to be one of the more likely non-employment-related consumer income that you will run across in your underwriting analysis. So rental income must be established as stable using a current lease, an agreement lease, or a 24-month rental history free of unexplained gaps. And they threw in greater than 3 months because I think they want to account for for students who might be renting your apartment, September to June, but not necessarily July and August. Those would be kind of summer months. So they do have this little caveat for 3-month gaps. There are additional restrictions if you cannot use rental income from the property being vacated by a consumer in favor of another principal residence unless you either have a special relocation situation or that property being vacated has sufficient equity, and it's an LTV of 75% or less that is going to determine whether or not that equity is sufficient. Okay. The non-taxable and projected income, this was what I mentioned briefly on the child support slide. So you may increase income that is not federally taxed by the amount of continuing tax savings that will be enjoyed. So if you have consumers that are not required to file federal taxes, you're going to use the rate of 25%. There are, for example, so this would be Social Security income, any kind of non-taxable income may fall into this category that would allow you to actually increase that income before you use it for qualifying purposes. There's a lot of specific details on that in Appendix Q. Unfortunately, we only had an hour, so we can't possibly go into each and every special rule, but what I'm trying to do here is kind of alert you to when you might be venturing into an area that you're going to need to pay careful attention to the details in Appendix Q. Projected income. These are issues. So, for example, you have a cost of living increase that happens every year. If you verify that with the employer and it's scheduled to come within 60 days of closing, you may be able to count that for qualifying purposes. Also, projected income in terms of whether or not there's a new job that's going to start within 60 days of closing. As long as you verify that there is an employment contract in place and that there is sufficient income in order for the consumer to make that mortgage payment between closing and the start of employment, then you would be able to use that income as well. Okay. The second part, so we're done getting you to the income that you're going to use for your debt-to-income analysis under Appendix Q. But now, in addition to that monthly housing payment, there's going to be charges for the recurring obligations that need to be included in that total debt-to-income ratio. And those are your obligations under installment loans, revolving charge accounts, other real estate loans, alimony or child support. And Appendix Q does include the same kind of exception. I think this is also in Fannie's guidelines. If you have a debt that will be fully paid off in less than 10 months, you might be able to exclude that debt from the total debt-to-income ratio, as long as if you were to include that amount, it wouldn't affect the consumer's ability to pay the mortgage during the months immediately after closing. So you have to be cognizant of this additional step. Just because it's going to be paid off in 10 months, if it means a consumer is not going to be able to make those first two payments, then you're not going to be able to exclude it. All right. A little note here on contingent liability. In the event you have a borrower that has, for example, co-signed a car loan or a student loan for their child, but if they are able to show documented proof that the primary obligor has been making the regular payments during the previous 12 months, then you would not need to count the potential obligation as far as the debt-to-income ratio calculation goes. Okay, we're in the home stretch here. So we talked all about those 6 criteria that get you to your general QM status. If you have loans that, for example, are not going to have a debt-to-income ratio that is less than 43%, you may still have a QM under a special rule. Many institutions are going to be relying heavily on the eligible loan special QM. So what that is a situation where if your loan is eligible to be purchased or guaranteed by Fannie and Freddie, as long as they're under conservatorship or HUD or VA or USDA, then you have a QM loan using this special rule. Now, it has to still comply with the restrictions for payment features and the limits on points and fees. But what this eligible loan QM does is get you around the underwriting QM criteria. If you underwrite using Fannie's guidance or Freddie's guidance or HUD's guidance, then those criteria are basically replaced by the GSE or the different underwriting criteria for the program that you're using in terms of your analysis. So what you would want to show if you had to show someone that you have a QM using the special rule, keep in mind that the underwriting guidance from this additional entity is going to replace just those last 3 general QM criteria and not the first 3 related to transaction terms and conditions. Another option, special rules, balloon payment QM. This is going to introduce the concept of the small creditor. This is a temporary option, also available to creditors regardless of whether or not they're in a rural and underserved area until January 10th, 2016. So the original balloon payment QM was limited to small creditors in rural and underserved areas, but as kind of a change in one of the final rules, so long as you're a small creditor, you're going to have 2 years that you don't have to worry about operating in a primarily rural or underserved area to be eligible to make these balloon payment QMs. Just a quick note, they did adjust accordingly the small creditor threshold. So now in 2014, in order to be a small creditor, your total assets have to be under $2,028 million. That was reset in January, but you still have to have originated less than 500 loans subject to the ATR rule in the past calendar year in order to be considered a small creditor. The list of rural and underserved counties is, of course, available on the CFPB's website, and you will also be able to find the adjusted limits there for special small creditor status. There is an additional small creditor QM. These are those loans held in portfolio, but keep in mind you can lose your special QM status if you have that loan leave your books within 3 years and it doesn't fall within one of these particular limited exceptions. And so if you have had a transfer as part of a merger or acquisition, they're going to give you some leeway here in terms of its QM status. But basically, you've got to hold it for 3 years in your portfolio. The last couple of slides here, I'm not going to go through. I just wanted to show you we have a QM readiness checklist that's also in our implementation guide. It has some finance charges, shortcuts, and little recaps of the included, excluded particulars of the points and fees. And I want to make sure we have some time for your questions. We have a few minutes, and anything that I can't answer today, we will make sure to follow up with a response to you after the presentation. So we're going to start with the real estate-related fees. Can you give an example? Actually, I think this question came in before we hit that slide, so it is on a slide in the presentation. And if we have, what is the difference between an HPML? Can you, if there's time, explain what the difference between HPML and HWEPA is related to QM? Okay, so keep in mind here that you have other rules that have gone into effect, such as HWEPA's restriction for high-cost loans, which is now applicable to a broader set of loans. But HWEPA's coverage for high-cost loans is actually different. It is not based on the comparison of the APR to the APOR index, which is the HPML threshold calculator, and it is the HPML status of a loan that is going to determine whether or not the QM is a safe harbor QM or a rebuttable presumption QM. So if you have a QM that happens to be an HPML, so that is the threshold for first liens is 1.5 percentage points, then you will have a situation where you have a slightly different level of legal protection. That would only be a rebuttable presumption QM. We might have time to squeeze in one more. We are correspondent with Freddie Mac and an FHA third party that closes loans in our names. We don't have to count the gain. I might have to respond to that one afterwards because I don't think we have enough time to do it justice. So with that, I'm going to turn it back over to Seda. Thank you so much for your time. I apologize if I talked a little fast. There's just so much to talk about. So please feel free to send questions and follow up. And we have a staff here that happens to be comprised of compliance consultants as well as underwriters. So this is our rule. If we can help you in any way, please don't hesitate to let us know.
Thank you very much, Marissa, and thank you very much to our participants as well. Like Marissa said, we apologize for running a little bit over for the Q&A session, but all of your questions are being recorded, so please feel free to continue to submit those, and we will respond to you offline. Or in addition, Marissa's contact information is on the screen, and you can go ahead and contact her, and either her or a colleague will follow up with you. As a reminder and a follow-up, we will be sending you a link to the webinar recording as well as the presentation slides within 10 business days. So watch your email for that, or feel free to contact me if you don't receive that in that time frame. And thank you again for your participation. We ask that you do please stay connected to the web portion of our survey until our web portion until our survey appears on your screen. At that time, you can go ahead and we'll disconnect. Thank you very much. Have a great day.